Live. Hello out there. How are you doing? We are live. Welcome to another live session that we've been doing since the year began. Really excited about that, and glad you are joining with me today. Me is Dominique Henderson, your CFP on YouTube, and I'm happy to be here to help all my aspiring financial professionals kind of navigate what I feel can be at times a pretty lonely and difficult path during their first few years in the business. So make sure you shout out to me if you're on the live stream joining us. And also, I listened to the replay last week and there was a lot, the mic was extremely hot. So if the audio is bad or is not coming through good, please let me know. Just kind of tap me on the shoulder through the comments. But if you're joining, please let me hear you so I can know the audio is good. That would be helpful too. So I appreciate that. And like I said, shout me out in the live stream. Would love to hear that you are listening and that you are in the community. So I can show you some love that way too. And if you will be so kind to leave your questions in the comments, I'm going to save room like I've been doing to answer all those questions for you. And that's the way we're going to do it. So today we are going to break down the financial planning process. We're going to understand the full financial planning process that you would take a client through if you are serving those individuals in a financial advisor type capacity where you're giving them investment advice, financial planning, things of that nature. Hey, Jerry, what's going on, man? Checking in from Costa Rica. Must be nice. Sand between your toes, my friend. A little bit jealous. Anyways, I've had so many people ask me, what process, Dominique, do you use with prospective clients? And so I'm going to share that. It's not going to be anything new. This is actually on the CFP's website. I've abridged it for how I work with people and what I do. And I think, of the 85,000 CFPs, everybody's probably switched it up just a little bit. But I'm going to share that today and share what I, coach advisors on using for their own practices. So I would say if you are in the if you're in the camp of, I want to be a financial advisor, this is definitely the episode for you. If you are thinking about hiring a financial advisor because you have wealth or are coming into wealth, you probably want to stay tuned to this one also, because if your financial advisor is not doing this, you may want to ask some questions. I'll just say that. So we're going to talk about all that stuff today. I think let's start here. So by the end of this, what I want to do is I'll do this later. Actually, let's do it now. Let's share my screen and show you the what the financial advisor board expects you to be using when it comes to this kind of stuff. And then we'll pivot back to what I'm going to use and show you, which is an adaptation of that kind of stuff. And so let me set all this up. All right. So you should be seeing what is the CFP board's 2015 job task analysis. And what this means is that when you are studying for the CFP and going through the coursework, they poll the CFP community and say, hey, what are you doing, Dominique? How are you planning with clients? What are things that you need? And there's a framework for most of this stuff. And as you can see, I'm not going to go through all this, but it shows you all the variables that are included in specifically the test and the exam and the educational requirements. That's what everything is made up of. But on to the right of this graph, you can see all the financial planning job domains, right? So there's all these steps. There's 8 of them. When I was going through it, there were 7 of them, but they keep expanding this. But anyways, the point is you've got to go through these steps if you are going to be rendering what is called comprehensive financial planning. And so you'll hear me reference some of these. And like I said, I will have this in my show notes for you to peruse later. And I will be having, some of what I'm talking about today is going to be an adaptation of that. So just want to share that with you real quickly. All right, now let's get to what I feel are 4 steps. I've kind of condensed mine down to 4 steps. And so let's go through those. So first, you got to get to know the client. Seems pretty obvious, but there's some things that go into that, right? So if you're following along with the SIFI standard deal, it's establishing and defining the relationship is what I think they call it. But here is where I like to lay the groundwork. So my specific deal is usually people are going to go through a 3 to 4 meeting process with me. And I'm just saying this parenthetically, and I'm going to hit back to my first point about getting to know the client. Usually it's going to be an introductory meeting, which is like 15 to 30 minutes. I try to let them do most of the talking because I want to know, A, if I'm a fit for what they need. And B, if I am, what is it exactly what they need? Different people come with different frameworks, although they fit under the umbrella of help me with my finances. It could be investment planning centric. It could be tax planning specifically. It can be insurance. It could be asset protection. There's so many different variables. So you got to let them talk. And so in this meeting, I'm really laying the groundwork for how the relationship will go. And I think you set expectations in that relationship too. That's another thing that I bring out with my get to know the client. I'm a virtual financial planner, except for my clients that live in Texas or Dallas rather. And for that matter, if they're not good with having a virtual relationship, then it's not a good fit. So I'm asking questions of that nature, seeing if there's been any history with financial advisors. Is this the first time? Like, why did you even come to a financial advisor? What are you trying to accomplish? I would say a lot of the rules and regulations, and frankly, the trouble that people can find themselves in if you're in this line of work revolves around what the client expects from the relationship and what you actually deliver. So when a complaint is filed against a financial advisor, it's usually because you haven't laid a good framework for what the relationship is supposed to be. If they are expecting that you are supposed to take them from point A to point B in regards to their retirement income planning or their insurance planning or asset protection or whatever that may be, you need to define that. And if there's an expectation that they leave with some, semblance that you're supposed to be giving them financial advice and that they're supposed to be relying on you to do that, then that needs to be evidenced in writing. That's a whole nother podcast about the rules and regulations about that. But suffice to say, you got to get to know the client, get to know what they want, be super duper clear. There's no love lost at this point, right? You shouldn't be. Hopefully you're not at a point where you're so hungry for the business that you can't go through all these elements to make sure that they're a good fit. Because ultimately, if you don't bring on somebody that's a good fit and you're just bringing on business, that's going to be bad for you. That's, in my opinion, as a financial practitioner, it's a liability. So you need to think about it from that standpoint. So again, getting to know the client. Is the client leaving that meeting relying on you to construct a financial plan or manage their investments or whatnot? And what does that look like? The CFP board would say that if the client is relying on you to construct a financial plan, manage their investments, things of that nature, you have the fiduciary obligation to put the client's needs first, which also means it goes into disclosure, right? So you may not do this in the first meeting, like I don't. You probably have a discovery meeting set up for more, I would say, in-depth and granular discussions. But between those 2 meetings, while you're discovering, figuring out each other, you need to disclose how you get paid, especially if they ask. If you're going to get paid off of commissions from stuff that you sell them, let them know that up front, because before they make a decision to do business with you, they need to know that, because they can always come back and say, I didn't know that. And that's where a lot of grayness comes in. So there's nothing wrong with, this whole argument versus fee only and fee based. I can really care less. Put the client's interest first, disclose how you get paid up front so that you don't impact their decision to work with you because they didn't know how you were getting paid. End of story there. Okay. I would also say that this part is not just quantitative, right? So you're not just taking how much money do they make, how much money do they have right now, how much are they saving. There's also things like the qualitative part of it, right? So the CFA, Chartered Financial Analyst curriculum, really goes into the different, especially in the behavioral finance component of it, goes into the difference between quantitative and qualitative data that you're collecting. Qualitative is going to be more around their money story, right? Did they grow up in, less than average income, and therefore money was never talked about, or maybe money was talked about all the time and they did grow up in that. So everybody comes to the table with their own mosaic of thought, and you have to kind of piece through that. So you're probably like, at this point, I don't know if I'm qualified to start asking those type of questions, Dominique, because I'm not a psychiatrist or a psychologist. But I'm telling you, when you start talking about people's money, this is a road that you often have to travel. And so I think one good lesson, or one good question that I picked up from Dr. Brad Klontz is that when you're talking about risk and you're talking about investing people's money, one good question is to say, what did you do with your investments in the last recession? And just kind of gauge their response, their body language. If you're, in a meeting with them face to face or virtually, it's a little bit harder to do that. But you can, tell things like tone in their voice. But knowing what they did with their last, in the last recession with their investments is really telltale, right? If they sold everything and like an ostrich stuck their head in the sand, or if they were like, I bought more, those are all really good signs about predicting future behavior. So what are some other qualitative questions that you might consider? You can type those down in the comments. I would love to hear your thoughts. Let's move on to the second point. You have to then analyze all this data that you're picking up, quantitative and qualitative. That would be the second thing you're doing after you define the relationship, which involves collecting this data, gathering all this information. This is usually what I do after my second meeting with them, knowing that they want to go forward. I'll probably present them with a framework and outline of what a plan would look like, some of the things that they said that is important to them. Then you start collecting all this information. And then what do you do next? Well, you have to start to synthesize it, right? You have to break down their family budget they gave you, their investment statements, and their life insurance policies, all this stuff into bite-sized chunks that make sense, so you can start to understand and put together what their financial picture looks like. Because before you can give recommendations, you have to first understand who and what is going on in their financial house, and then begin to chart a path for success. So that's all under the analysis of your findings. And I would say this could be particularly difficult in your first years. So what you're going to see, and I talked about this on, I believe this was Monday's episode, about the first few years in the business. First few years in the business, 0 through 3. This is the reason why clients don't normally hire you if you're on your own, because you're too junior, you're too green. You don't know, you probably know how to put this stuff in financial software, but you don't know how to put it all together usually. So it can be particularly hard to win business, win trust. So what you normally see is senior advisors or more seasoned advisors step in, firm owners at this point, take the data that you synthesize as a financial, professional that's learning this craft, and then they'll present it to the client because you don't have any experience. I mean, case studies that you read about through your CFP curriculum only kind of take you too far or so far. But when somebody shows up in your door and they're just like, my spouse just died, I got all this insurance money, I don't know what to do. Do I sell the house? Do I pay for my kids' college? Things of that nature. Or my dad died, I inherited money, There's so many different things I can go on and on there because I have a lot of experience. But the point is an older financial advisor is going to be more equipped here than a younger financial advisor. So it's good to kind of pair those for seasoning and things of that nature, mentoring, because all client profiles can be different. And the more cases you see, the better. I was just actually talking about this in my course is, there's no substitute for time. And a lot of people want to rush time, but you can't rush time. You just got to sit around and you got to experience it. And over time, you will get the experience, and you will see scenarios that will allow clients to trust you more and things of that nature. So that's kind of what I would say as far as analyzing the data. So the other thing is just, it's so hard to kind of articulate this without giving a story. So a client's going to come to you and tell you, hey, I got X amount of money right now and I want to retire in Y years living on Z expenses. And the financial software is going to spit out something. I mean, it's going to give you a number. It may be right, wrong, high, low, whatever. But I'm just going to say that's like 2% of the battle. And the reason why is because people change. Their stations in life change. They get divorced, disabled, they die, kids leave the house, they change jobs. And then so that plan, as soon as the ink is dry on it and you hand it over to them and start giving them recommendations, things then change. So I would say, I mean, a lot of financial advice and a lot of this job is getting to know the client at a deeper level for the relationship to build, so the trust can be there. Because at the end of the day, you can do all this financial planning, all these plan makings, and then people don't take your recommendations. And why don't they take your recommendations? It's not because they didn't pay you a lot of money, or that you don't have the credentials, or that you don't, or that you you obviously know more than them in this area. It's because of trust. People will not take your recommendations and your advice unless it benefits them, in which case there has to be some type of trust established there. So analysis of the findings is great, but during this time, make sure you're concentrating on the EQ portion also, which I'm gonna talk about in just a second. Hello, Ugochi. Thank you. You're listening as you drive home from work. That is what I call dedicated. That is great. Thanks for the love there. I appreciate it. Okay. So let's say, or let's move on to the third point. After you collect the data, after you get to know the client, collect the data, analyze your findings, then you get to present the plan, right? So I would say IQ, obviously competency is good here, but EQ is huge here. Being able to communicate clearly your thoughts and your analysis so that the client feels like they're being heard, in being able to communicate that in plain English to the client is key. Not financial jargon. Those are not the same things. Financial jargon, where they just, their eyes are rolling over, glossing over in the back of their head. I mean, you want to stay away from that. And I want to emphasize plain English. Let me just say something. I'm gonna step up on my pedestal real quickly here. This industry has, for far too long, extracted its fair share of rents from the investing public, from consumers of financial services, without equal remuneration in most instances, not all, in most instances. That's why the public has this persona around financial advisors that is, salesman-ish and all this other kind of stuff. That's why it's really important that you take your time, communicate with the client after building trust, all your analysis to them. And I think, so this would mean that you're not taking this big plan and analysis and just dumping data on them and overwhelming them and talking over their head. You are collaborating with them on their goals, on what they feel is important. You're going through a rubric of their money story to figure this stuff out and extracting those goals in some type of, hopefully, a goal articulation exercise that says that, I want to be retired in 15 years, making this amount of money with my house paid off so that I can travel 6 months out of the year, whatever. I don't know. But the point is you need to get really clear about that. And you need to have the client tell you that. And so that the plan encompasses that particular goal. That is what's important to the client. So, I mean, there's different ways to extract that, right? So you might say, hey, so-and-so, I found blank, what you said about so-and-so particularly interesting. Will you unpack that a little bit? What are your thoughts on that? I'm curious. Or you may say something like, took me by surprise that you said that. Why don't you give me a little bit more context? This is how you dig a level deeper to kind of understand where they're trying to go, instead of just, I want to retire in 15 years. There's a reason why they want to retire in 15 years. So make sure your plan presents that. And then after you present the plan, my fourth and final point, you have to monitor it. After your client has, let's call it the warm fuzzies about this great plan, now the actual work begins. And I would say, the goals part of it, like Jerry's asking right now, is all in the monitoring of this, right? So you've got the goals that you've extracted. Hopefully up until this point, you should have a clear picture of what the client's goals are because you've already presented a plan. And then it comes to how are you going to deliver the services, right? What did they sign up for? Is it 4 meetings a year where you're going through, the investment accounts for 30 minutes a pop? Is it, monitoring their budget to make sure that their spending's in line? Is it paying down debt? Is it raising their credit score? I mean, the sky's the limit there because everybody has something that's important to them. But the point is you should have found that out through the goal articulation. Otherwise, you're just throwing a lot of stuff at them that may sound great, but at the end of the day, they may have no motivation to carry it through because you haven't really captured what's important to them. So with service delivery, I think it's really clear to be, how often are you going to meet, what the meetings are going to be about, what are you going to talk about during those meetings? Sometimes it's good to just give a service calendar. Clients, to know that, okay, in the months of January and February, we're going to be talking about taxes and things of that nature. Or, in the fall, we're going to be talking about open enrollment period and things of that nature. Because you got to have a way also that you gauge your success. And so let's cite real quickly a couple of frameworks that are easy for gauging success. First could be investment results. That's a real easy one, especially if you have a model where you charge assets under management fee. The pros of this is it's really easy to judge if their goal is being met. If they say, hey, Dominique, I need $5,000 a month in income, and I want to be preserving the capital so that I can have a distribution strategy to my heirs. Well, if you're able to send them $5,000 a month from their accounts, you met the goal. Now there may be some down cycles and whatnot in the market, and that may affect that goal, and then you'll have to work around that. I would say the cons would be that you can't control the market. We've been in a decade-long bull run. And so I would say, use benchmarks and things of that nature. It could be like, as long as I beat the S&P by 50 basis points each quarter or each year or something, you may make up, as long as I beat a 60-40 strategy, 60% in equities, 40% in fixed income, yada, yada, yada. There's different ways to do that. But I would say another one is goal achievement, right? So maybe people are thinking that goal achievement is lowering the bar because investments is so hard to, and managing that is so hard. But I would say there's some good points in that because you can set timeframes on short term. I want to have an emergency fund of 6 months. Medium term, I want to be able to, fund my kids' college by 15%. Long term, I want to be able to retire 5 years early. Like those are very measurable goals to see whether or not that worked. And I think goal achievement, as long as you have good goal articulation, can be a great way to measure your success and monitor the plan also. I think though, the caveat to that is what I said earlier is if you're not good at the articulation and goal setting, and then you couple that with client situations changing, you got to have a really good tight framework for how that's going to work. Otherwise, your client may just end up being disappointed. And so there may be some other frameworks out there that you want to throw in the comments. I would love to take a look at what you're thinking, what you've come across, yada, yada, yada. Those are all good things. So that is it in a nutshell. It is getting to know the client. After you get to know them, then you need to collect their data. You need to analyze that data. You're going to present the plan, and then you're going to monitor the plan. So all this is very doable, and it pretty much follows the CFP board framework pretty closely. If you kind of break that down, and like I said, I'll leave that on my website. I do have some questions in the chat that I want to get to, and I also have some community comments. So let's do how we normally do and save these last 5 minutes or so for those. So let's pop over to the pre-submitted comments, which I always get to first. So this is Jonathan Brown, comes to us on the YouTube channel. Jonathan, thank you for watching and subscribing. I appreciate it. He says, I listened to Dave Ramsey's channel and this video popped up. Good to know that I'm coming up after Dave Ramsey. It's neither here nor there. Thanks, Jonathan. Helping people with their finances sounds fascinating. However, I can't see myself selling a product because I have a hard time expressing my train of thought. Is this a deal breaker? Maybe. And why do I say maybe? I say maybe because in this career as a financial professional, you can be front facing like I am. Like I am the lead advisor. So when somebody comes into my practice to do business with me, I am the person they talk to. I don't hand them off to somebody or something like that. So that means I'm there for client service. I'm there for prospecting, which is what I'm about to get to answer your question, and any other things, some of which I outsource to my back office. But the point is, if you're going to be front facing, which means you're going to be seeing clients a lot, you're going to be talking to them, you're going to have to develop that skill. And if you're not good at it, then that may be a problem for you. But I will say there is a saving grace. There are a lot of paths in financial services that you can follow down that don't involve you having to sell anything or being front facing. Usually front facing and selling are pretty synonymous. There are some roles that I'm about to explain, like for instance, my last role with a firm, I was not responsible for business development, but I was responsible for 200 client relationships. So all their service aspects, reaching out to them, that particular skill set I had to use all the time. But I would say just as long as you're a good communicator, you said train of thought. If you lose your train of thought, then that could be a problem, whether you're trying to sell or whether you're trying to serve clients. Otherwise, you may want to hit a compliance role, a back office role, operations, things of that nature that don't cause you to have to interact with the public as often. So that is Jonathan's answer. This comes to me on Instagram. I also get a lot of Instagram DMs. Thank you guys for supporting me on that channel also. Sambag98. I'm sorry if I'm pronouncing that wrong. He says, hello, Dom. I found you through your YouTube channel. I recently received a job at AXA Advisors. What are your thoughts about that company for starting off my career? I am in the last quarter of my school and I am studying for my certifications. Do you have any advice for a person in a situation like me or any advice to be successful on the test? Okay, so a lot of questions there. You're getting a three-banger right quick, Sambag. All right, so first of all, I don't really care about what company you work for as long as they are ethical. They align with your own why, establishing your why, something I talk about in my course. I'll probably put that banner up in just a second if I can think about it. I always forget to self-promote. Shame on me. Okay, so anyways, if the company that you work for doesn't matter, matter of fact, the company that I was just talking about that I had the responsibility of 200 client relationships, one of my colleagues, she worked for AXA forever. And she's a great stand-up person. So it's always the person. It's never the company. It's always the person. If you find that in your company, you're having to sell products that you don't believe in, then leave. So, but sometimes you get great training through some of these opportunities. So I would say there's nothing wrong with AXA. Definitely as a start. Do I have any advice as far as studying for your certifications? I would say find an education program. Kaplan, I don't know what you're studying for exactly. You didn't mention this in the comment, but just follow the curriculum that they give you. Usually, for instance, I used Dalton to study for my CFP, did exactly what they said to the letter, passed the first time. I felt like I was over-prepared for the test. I've mentioned this before. So follow exactly what they're telling you to do, and you should be fine. This is a part of your life where it's sacrifice, right? So I didn't watch TV for 2 years while I was doing my grad degree and studying for the CFP. So tough nookies if you like to binge watch on Netflix. All right. Holy George, Instagram comment, and I'm going to get to the chat, and then I'm going to go eat some dinner. Holy George says, being into stocks and Forex. I remember this comment. It was actually pretty lengthy, but I summarized it, paraphrasing. So he's into stocks and Forex, and he's wondering if he can trade for people and make them money and take a commission for himself. Is this legal? The short answer is no. You may find some ways around it, but in order to trade for people, you have to open up an account on their behalf. And there are strict regulations around commingling of money. So you couldn't like say, oh, I'm going to put your money in my account. That just gets all really messy. It's just do it the legal way. Be regulated, follow the Investor Act of 1940, which, basically outlines how you are regulated as a financial advisor, somebody giving investment advice and charging for it, and do it the right way. I would just don't make it complicated. It can get so messy if you don't do it the right way and you fly under the radar. Back in the day, and I did give him this answer on Instagram, back in the day, Warren Buffett had a I think it was organized as a family limited partnership that disbanded after he made them millionaires. I don't even know if that way is still around. I would imagine a lot of those people were probably accredited investors, which is a whole nother thing. So you can just look that up. It's been chronicled in many books. Look up Warren Buffett's partnership before he started Berkshire Hathaway. Okay, into the chat. All right, Justice Smith, thank you for listening and staying with us. If you're still here, said this may be off topic, but is the tax section of the CFP, does it cover stock options? Not the tax well, I guess it depends on what do you mean by cover? So the stock options are covered in probably the fundamentals part, where you're actually going through investment types. Memory doesn't serve me. I have a hedge fund background, and so where I learned my knowledge is, I'm trying to remember. It's all squishy right now, especially at 6:30 in the afternoon. I would say that the tax portion in the CFP program will show you the taxation of different investment vehicles. And really the thing that you need to know about stock options is a short-term gain or loss. Short-term gain or loss or long-term gain or loss, and how those are treated. That's the real thing you need to know. There's no particular taxation around stock options per se. So if you're still with us, Justice, you can give me a little bit more context for that question. But as far as I know, and as far as I remember, rather, there's nothing specific around stock options that you need to know beside the disposition of the tax lots being short-term, held less than a year, or long-term held longer than a year. Jerry, I think we should deliver. Okay, thanks, Jerry. That it's like the drip on a rock, right? It's just continual persistence there. Appreciate you, my friend. Let's talk about also my Facebook page real quickly. Make sure you go there and like it. I've redone it as of yesterday. It is all JUMPSTART Coaching Lab centric. So make sure you go and check it out. And last but not least, we got Trent in the chat that comes to me and says, love your channel. Thank you, Trent. I appreciate the love, my brother. Currently enrolled in my university PFP program. Greatly appreciate the insights on video. Okay, no question, but thanks for the love. I appreciate it. Wanted to shout you out there. If there are no other questions, I am going to put a pin in it for today. Thank you for sitting and watching with me, and I appreciate the support. We'll see you back next week. Bye for now.